All right, hello everyone. Welcome back to the channel. I believe this is Robinhood episode 21, and today the portfolio has spiked up $6 with the after hours having a $7 return. So all in all, the markets have been really good. We're going to talk about it all. We're going to talk about what the market has been doing, how I feel about the market, and what are my outlooks. But to start this video, I want to talk about my gains for a minute here. For the month, I am up $551. The week, I am up $147, and for the last 3 months, I am up a whopping $1,000, $1,1200, almost 10%, which is a really killer return. But so the markets in general have been very bullish. I believe in the last video I talked about how everything's going up and everybody's just happy and losing their minds. This is the longest bull market ever. We are officially in the longest bull market ever, and the S&P 500 continues to reach new heights. The Nasdaq, I think, soared above 8,000. Everything's just going up, and everything is just touching the sky. But what I want to talk about today is my portfolio, and we're instantly just going to jump into this portfolio. I'm not going to just fool around here, so let's do it. We have Apple, we have Nexer, really the same stocks that I had in the last video. There have been only minor changes with this portfolio. I sold off a couple of Verizon shares. Like I said, I had 20 Verizon shares, and now I have 10. But I'm gonna get to that in just a second here. So I'm gonna talk about a new stock in my portfolio, and that is Phillips 66. Now, listen, I said in the last video that I do not like oil stocks, and I still don't. I still don't like oil stocks. But you know what? I do like diversification. I do like diversification a lot, but I like the right amount of diversification, if that makes any sense. With that being said, my portfolio had a glaring weakness to it, and that was not holding an oil stock. Now, there's a lot of oil stocks in the market that I could have bought. There was Shell, there was Chevron, there are a lot of oil stocks. There's Phillips 66. They're just all over the place. But I think ExxonMobil, and I love mobile gas. I always buy mobile gas, and it's no wonder why I didn't put ExxonMobil, ticker symbol XOM, into this portfolio. But the reason why I bought Phillips 66 was because I looked at the graph, I looked at the 5-year charts, I looked at what the company was doing. So I did a lot of background history with this stock, and it's not because of the fact that Warren Buffett bought it. I did hear about him holding some shares in this, but at the beginning of the year, I believe it was, he did short this stock a lot. I think he short this stock about 8%, 8 or 10%. I'm not sure if that's accurate, but he did sell off a whole bunch of shares of Phillips 66. I think when it was around $115. But I looked at the 5-year graph, and one of the things I saw was Phillips 66 was doing really. I wouldn't say, they weren't doing really well when that oil correction happened, but they did not get hit that hard as much as these other stocks. I mean, they still dipped pretty bad. They almost lost about 20% to 25%. But you look at companies like ExxonMobil, you look at companies like Shell, and I compare their 5-year charts to stocks like Valero Energy, VLO, ticker symbol VLO, and PSX, and I just look at when I make those comparisons, I see that oil stocks like VLO and PSX didn't get hit as bad, and maybe that's due to like company management, maybe that's due to just solid marketing, but this is not a bad graph, and I'm not saying that I bought this stock because the graph looks it looks incredible. I mean, even the 137% return is pretty good, but I don't know. There was a lot of factors that made me buy the stock. I like the graph. I do like to sort of mimic Warren Buffett's investments a lot. He's one of my favorite mentors. He's a good mentor to me, and I like him a lot. I like to see what he's doing and what he thinks about the market in general. He's one of the best investors that that ever lived. So I don't know. I just like to follow his methods and listen to what he thinks about the bull market in general. But my return for PSX up $33, and that's my total return. And I am in at an average cost of $116. Now, listen, I'm not a fan of oil stocks, and I'm not a fan of this average cost. This stock really is in my portfolio because I just saw a weakness with a glaring hole into what I wanted to do with this portfolio. I wanted to have complete diversification among all the market sectors, and I didn't really want to go above 15 stocks. Now, with that said, I have 10 stocks into this portfolio right now, but I am fully diversified. At least I feel like I'm fully diversified without taking extreme risk, if that makes any sense. But, when I look at this average cost, I am not a fan of it. I am not a fan at all about this average cost. I'm not even a fan of just, keeping an oil stock into my portfolio right now because they have gone up so much. But with that being said, I did address an issue. I did put Phillips 66 into my portfolio, a great oil stock and a great energy stock that patches up those needed holes that I wanted to sort of cement over. So, I'm up $33. I don't have a stop loss on this yet, but I am going to put a stop loss on this eventually. And for I think the 52-week high, $123. So yeah, I'm right near the 52-week high. I wouldn't say this was a good buy, but right now, the stock has been giving me some really good returns here. Very, very good sort of perspective on keeping stability in this portfolio and balancing everything out. So now that I talked about that, I want to talk about Apple. They're just on a killer run. I love this stock. I love the fundamentals with this stock, and I just love everything about this stock. They hit $1 trillion market cap. Total return is up $270 for a 14% increase. I mean, that's just phenomenal. There's no words that I can say more about that, but the equity, this is the largest position in my portfolio, and I want to keep this the largest position in my portfolio. Apple is a sound company. They have a very low PE ratio, and they hit $1 trillion market cap. They are increasing their dividends. So, just little things like that. When you do your research on your stocks and you're picking stocks and you're saying, oh, what should I buy? What should I buy? I'm not saying, buy Apple now because it's shot straight up, and, I like to buy stocks on sale, but, it doesn't get more technically sound than Apple. I mean, this literally is my favorite tech stock on the market. I know everybody likes Amazon. I know everybody likes Microsoft. I know a lot of people like, I hear Texas Instruments a little bit. I notice a lot of tech stocks I miss. And, the FANG stocks, Netflix, all that stuff. But Apple is where it's at. They do so much. They have a really good a fundamental approach about their marketing to people. And, when we talk about diversification, when we talk about what tech stocks should I buy, the reason why I have, just one tech stock, I had two. I have Microsoft in here too, and I love Microsoft. Microsoft have great returns. They've been trending up a lot, but, I don't know. It's like when I look at other people's portfolios and I see many tech stocks. I ask myself, what really is diversification? Is it just like owning a tech stock and just one tech stock that you really like, or would you like to own many tech stocks? And most people have like FANG in their portfolio or some certain stocks of FANG, like maybe just like some Netflix shares, maybe like an Amazon or something like that. But what do you guys think? Like what counts as diversification? Because Apple does a lot of stuff. They make computers, they make phones, they have Apple Music, they have iTunes, they just do so much. And when you buy a stock, you have to look at strategy. And, you look at a stock like Apple, and you say, oh, well, Apple, they do all this technology, and, maybe I could buy a Microsoft so I can get into cloud, and I could buy Alibaba because I want to get into e-commerce. But, what really counts as diversification? Because if you're holding like 7 tech stocks or something like that, and the tech sector goes down, you're going to get hit pretty bad. Your portfolio is going to suffer. So, maybe that's the reason why I said to myself, I just want to own 10 stocks, and I want to keep my diversification, even though I'm in the tech market because I have Apple. But we look at what Apple does. Everybody has an Apple. Everybody has an iPhone. Everybody uses, well, not everybody, but people use Apple Music. They're in direct competition with, I think it's Spotify or something like that. But yeah, they're getting better. They make computers. Like they do so much. You get so much out of just one stock. And that's you look at a stock like Amazon, and why is it so expensive? Well, that's the reason why. It's expensive because they do so much. And you can literally buy one Amazon stock and have complete diversification right there across everything, because they are doing everything. They're in the groceries, they're in e-commerce, they own Twitch, like they do everything. So, what really counts as diversification when we talk about buying just one stock, or we talking about buying many stocks, and just being, maybe you're just better off just buying, Amazon, and just calling that your diversification or something like that. But as you can see, Apple's been really good to me. I'm not going to waste any more time with Apple. It's self-explanatory. One of my favorite tech stocks, and I'm going to just add more shares. I like this portfolio. This portfolio is, there's not a lot to see here, but sitting almost on, we're headed to $15,000. I reduced my Verizon shares. I want to talk about this just right quick. I reduced my Verizon shares because, again, I said it in the last video, I don't like buying at these prices. I believe Verizon is going to trend back eventually. They've had a really good run here for the last 3 months, but it's got what it goes up, it has to fall back, guys. It's not going to keep going up, and that's the reason why I sold high. I started selling shares, and I said, you know what, I'll just keep 10 shares. And when it gets back down to that $50 range, that's when I'm going to buy more. So, I had 20 stocks in the last video, now I have 10 stocks, and I moved that money around. So, you look at stocks like Starbucks, they're still here. 3M, they're still here. But, this is a sound portfolio. This is probably, it's getting to the point where I don't really have to manage this. I can just move on to other projects, which is what I want to do. I want, when you wanted to reduce your risk by being in a market like this, and, everything's sky high right now. Everything. And this can all end anytime, any day of the week. This could all end. But one of the things that I always see is you have to have a level-headed approach to the stock market. And what I mean by that is that I've seen people who try to time things, and we can't time when the market's going to crash. We can't time when this bull is going to stop charging. And some people, they say that, and they say, hey, the market's going to crash soon, blah, blah, and I'm going to prepare for it. You can't. That's the thing. You can't prepare for a crash, because while you're preparing for a crash, you're losing out on all those gains. Okay, you're losing out on all those gains. I've seen people lose more money preparing for a crash than just letting it all happen at once. And just, doing investing in stocks and not trying to time the market. So they're losing money trying to prepare for a crash. They're putting all their money in index funds and blah, blah. And the thing is that I'm actually a big fan of index funds and ETFs. A lot about what Jim Cramer was talking about on one of his Mad Money videos. And I will say this. I am not the biggest believer in Jim Cramer. In fact, I think Jim Cramer, this guy, I don't want to say bad things about him, but it's to your own perspective. And, the thing is, I don't believe in everything that he says. But some of the things that he does talk about in those Mad Money videos I watch them sometimes. They do make sense. Like, I believe I was watching one of his videos, and he talked about there's people asking questions like, "What? Hey, I'm a beginner investor, and what should I do with? How should I start investing? What should I do? What avenues do? How do I approach this?" And Jim Cramer's all like, first off, you don't. There is no approach to the market. Like, I mean, there is. That's not what I'm trying to say. Is that it takes money to make money, if that makes any sense. And some people, they start their portfolios off with $500, $1,000, $1,500, $6,000. But what Jim Cramer recommended was, I don't want you to buy a single stock until you have $10,000. And the thing about that is that if you have like $5,000 or something like that, or whatever, or something like that, or if you even at $10,000, what he recommended was putting that money in an ETF or an index fund or something that mirrors the S&P 500 like brilliantly. And there have been stocks that do that. There are stocks that mirror the S&P 500. One of my favorite stocks that mirrors the S&P 500 is VOO, Vanguard, that Vanguard S&P 500 ETF. And it really mirrors the S&P, literally mirrors the S&P 500 with an extremely low expense ratio. So, when we talk, and this all goes back to what I'm trying to say about diversification and everything. And the thing is that I may not agree a lot about what Jim Cramer says, but I do agree about that particular issue. Like, if you have something like $5,000, yeah, I do believe in the long run you're better off. You're probably better off putting it in an ETF like VOO that mirrors the S&P 500, so it minimizes your risk. Because literally, the ticker symbol VOO hits a lot of markets. It's heavy on technology, it's heavy on financials, and it's heavy on healthcare. Those are three sectors already that are extremely bullish right now. Like, they are extremely. Those three sectors I mentioned have the most bullish outcomes of this bull market right now. So the thing I want to say is, it all comes together. And when you get $10,000, and Jim Cramer says, hey, that's when you probably should start picking out stocks like pick out an energy stock. Or so you pick out an energy stock, you'll pick out a technology stock, you'll buy a retail stock, and you'll buy an industrial or something like that. But what you don't want to do is that you don't want to get any more than, say, 10 stocks, because you have a lot of homework to do if you do that. So, you're sitting there and you're buying all these stocks. You have like 18 to 20 stocks into your portfolio, and now you got to do a lot of research, because those companies are going to start, having earnings reports, and you're going to be sitting there and you're going to be doing your research. You got to research. You got a lot of work to do. So, why not buy an index fund and put it in something that mirrors the S&P, and there you go. So he mentions that, and you know what? I agree. I agree, and that's probably the reason why right now I only have 10 stocks in my portfolio. Not because Jim Cramer says so, but I agree that 10 stocks is what I like to be at. I mean, even 15 stocks. I've been to 15 stocks before. I think in the earlier videos, in my earlier Robinhood episode videos, I had maybe more than 10 stocks. I think I had like maybe close to 15 stocks, maybe more than that. So, the thing is that, I bought ETFs. I bought into these high expense ratio ETFs, and it's just funny where I've come from since those times when I had like $7,000, and I really should have put the $700 in an ETF and just left it alone and see what my returns would be. So, I just wanted to mention that and see what you guys think about, all this coming together, the right amounts of diversification, this bull market. We are in the longest bull market ever, and trying to prepare for a bull market. And the thing is that while you're preparing for a bull market, when you're preparing for a crash, when you're preparing for a crash, and you're sitting there, you're like, I got to prepare for a crash. I know it's going to come, but I just don't know when. That's the thing. That's what I think. That's the thing I want people to really think about when they're constructing a portfolio. And the thing is that a crash will happen. A crash will happen. We've seen a correction happen. A correction happened, and I'm just gonna go ahead and highlight it here. So we see the correction: $13,800, all the way down to $13,000. So I lost $800 in that correction, and that was only a 10% correction. So when we're talking about a crash, a crash of epic proportions, a crash will probably be around 30 to 50%. 30 to 50% correction. And this was only a 10% correction. At the time. At the time, this was a 10% correction. The only reason why it's maybe a 5% now is because my portfolio is so big. Well, it's so big in equity. But at the time, when this was around, I don't know, maybe around $700, $800, $7,000, $8,000. Yeah, I think I lost around 10%. And we seen the damage. So, that's the thing, guys. And, I'm just going to go ahead and talk about my portfolio one more time. We have technology. We have Nexter Energy, which is starting to trend back here. They are a great utility stock that I like. Solid numbers, solid market cap, an excellent PE ratio, only about a 9.86 PE ratio. I want to look into that maybe a little bit more because that looks a little bit too good to be true. I mean, this stock is $170, and they only have a PE ratio of 9%. That's almost Apple good. So I want to check into that. I really want to look into that and see how accurate that is. We finally have an energy stock, so we've taken care of that glaring hole, that glaring weakness of not having an energy stock. And I've shown my returns on that. Johnson & Johnson, healthcare stock, one of the better healthcare stocks on the market. A trusted healthcare stock, solid, fundamentally sound, everything. Everything is here with Johnson & Johnson. The Amazon of healthcare, they're going nowhere. They've been paying their dividends for the last 50 years. Solid. It's been trending back, but you know what? I'm in at an average low cost, and I want to buy more of this. I want to buy more, but I won't buy more unless I get to near my average cost. Procter & Gamble, another blue chip stock, proven, paying their dividends for forever. Nothing to say. Verizon, I talked about why I trimmed down my shares. Costco, because I need a retail stock. A little bit overvalued. I just clicked Starbucks. I didn't mean to click Starbucks. A little bit overvalued, but you know what? They have great growth. And every time I buy Costco, it dips, but I love them. And we'll see what happens with this stock. We really will. Starbucks, the thing about Starbucks is that they're increasing their dividend, and I like what they're doing. I just do. I just think that it's when you take coffee, and I've said this before in my other videos, when you take coffee and you make coffee and you sell it for $5, I mean, what more can I say? What more can I say? I mean, so you literally take a cup of coffee and you sell it for $5 or $6. That is a brilliant marketing strategy that people fall for. So when they can make their own coffee and it'll be cheaper. So Visa, everybody has a Visa card. Everybody's swiping the Visa card. The growth stock, tremendous growth. Eventually, we'll increase that dividend. I know that it seems low, but look at the market cap. Look at the PE ratio. And that's actually not a bad PE ratio for a stock like Visa where everybody's using it. And this is a financial tech stock, but it more falls in line with financials. So, I could probably put a bank stock there, but these bank stocks, and they bank stocks seem to benefit from rising interest rates, but I like Visa. Visa's there to stay. 3M, a solid industrial stock. Dividend aristocrat, paying their dividends. And this stock has been on a complete killer run here. Almost $100 return. Blue chip stock. It all comes together, guys. It all comes together. So that's my portfolio, and let me know what you guys think. We are up 10%. We're going on 11% now, and the portfolio is starting to get huge with these massive returns. But you know, it could all come crashing to an end. We don't know when we can't time the market, and I'm not timing the market, and that's the reason why I have stop losses on pretty much all my stocks, because it's all about preparation. It's all about doing the research, and it's all about trying to get ahead, getting ahead, and just making sure that your portfolio is protected with the right amount of investments. So that's going to go ahead and do it, guys. $14,299, and I'll see you next time.